It's time now for top picks from Stan Wong on this day. Amazon.com is top pick number one. Ticker symbol, of course, AMZN on the NASDAQ. Stan?
So certainly a behemoth with 2023 revenue coming in about $570 billion US dollars expected. Obviously a dominant player in the e-commerce, cloud service, digital streaming, and artificial intelligence space. AWS, Amazon Web Services, a cloud segment, continues to gain significant traction. They now command about a third of the world's market share in cloud infrastructure. The high margin advertising business is doing very well. That's all those sponsored ads at the top when you go on Amazon.ca or .com. That's scaling very quickly. Amazon Prime is now up to 200 million paying members. Last week they had a great showing in their Amazon Prime days. And now we're looking at about a 97% plus renewal rate from Prime members, which shows that loyalty and that stickiness of having all those different services within Prime. Amazon did underperform for about 2.5 years, but so far this year it's been outpacing the S&P 500. I see that continue to go. When you look at EPS going forward, we're seeing 25% plus earnings per share growth over the next few years.
Okay, Amazon is top pick number one. Number two, MasterCard, ticker symbol MA in New York.
Yeah, MasterCard complements our Visa holding in the portfolio. We're looking at about $25 billion in revenue. It's the world's second largest global payments company after Visa, of course. They're in 210 countries and operate in more than 150 currencies. When you look at what's happening with consumer spending, which is solid, we're seeing also demand in post-pandemic travel and higher cross-border transaction volumes, which is very high margin for companies like MasterCard and Visa. That'll lift recent and near-term going forward earnings prospects. If you look longer term, MasterCard's got a very extensive global network, a very, very formidable brand recognition, and their technological advancements will continue to keep them very, very competitive and protect their market share and profitability. It's really a toll booth business when you look at Visa, MasterCard, these types of names. These companies earn transaction, networking, licensing fees, regardless if the payments are credit, mobile, or debit. Last year, MasterCard initiated a very shareholder-friendly $9 billion share buyback, which they have been executing so far this year, and I expect more of that going forward. Looking ahead, we're seeing about 18% EPS growth rate over the next few years. So another good growth, secular growth company.
That's a remarkable, is that an annual pace of growth of 18%?
That is an annual.
That's remarkable. Where exactly is that coming from?
Well, keep in mind that that's coming out of the pandemic, which we saw a little bit of a dip.
Right.
So we're going to see a bit of a growth. But generally speaking, the huge demand in travel that's picked up, revenge spending, global and emerging market spending, and that just organic growth in those areas.
Okay. And number three on this day is the pharma stock that Stan referred to at the top of our program. Novo Nordisk is his pick in this space today. NVO on the New York Stock Exchange.
So Novo Nordisk is headquartered in Denmark. It is a global healthcare company, leading global healthcare company with about $32 billion in forecasted 2023 revenue. But we're seeing those revenues get ratcheted up every single time in terms of estimates. It was recently crowned as Europe's most valuable company by market cap, given the growth in the share price. And as you may know, it is the clear leader in diabetes care and obesity treatment drugs. When you look at insulin supply around the world, Novo Nordisk produces 50% of the world's insulin, which is significant. And over 36 million people around the world uses Novo Nordisk's products. Just last week, management raised its sales and profits forecast for the third time this year, based on soaring demand for its blockbuster weight loss drug, Wegovy, and diabetes treatment drug, Ozempic. Sales growth is now expected to be as high as 38% this year, and operating profit as high as 46% this year. There was a recent Bank of America research report that estimated that 48 million people in the U.S. will have used obesity treatment medications by 2030. Today, we're only at 1 million people that are using it. So lots of growth ahead for this type of business, this type of company. Earnings per share growth rate is at also around 25% going forward. So another secular growth company in our portfolio.
Stan, on behalf of our viewers, thanks a great deal for stopping by.
Thank you, Paul. Stan
Wong was our guest, and those are his top 3 picks on this day: Amazon.com, MasterCard, and Novo Nordisk. Welcome back. Time now to conclude our program with Gordon Reid's top picks. Number 1 on this day, Booking Holdings, ticker symbol BKNG on the NASDAQ. Gordon.
This is the 21st century solution to calling your travel agent and having to make bookings, or having somebody else make bookings on your behalf. Booking Holdings used to be the old Priceline,
right.
.com, and Bookings was their European hotel offering. Highly fragmented business in Europe and in Asia, unlike North America, where there's a lot of hotel groups. In Europe, mom and pop hotel groups that need reach. So Booking is an asset-light, online, software-based booking option, hugely scalable, and they've done a wonderful job doing that. They now own, as I mentioned, Booking.com and Priceline. They also own OpenTable for the restaurant business. They own rentalcars.com. They own Kayak. So you can see that they're basically connected to a lot of different areas, and they've actually coined the term connected trip to try to cross-sell across a lot of these offerings. Very profitable. They'll make $140 a share in 23. We think $160 a share in 24. So they're not expensive, and as I said, very, very well managed.
That's Booking Holdings, the top pick on today's program. Chubb is number 2, CB in New York. Chubb.
Yeah, the largest property and casualty insurer in the world, the 4th largest insurance company in the world. Their insurance companies make money one of 2 ways, or both ways. One is through their underwriting business. And if you have a combined ratio of less than 100, it means that just on the underwriting business, the money you bring in versus what you pay out in claims, you're making money, your combined ratio will be lower than 100. Theirs is actually just lower than 90, so a very, very good combined ratio. I think the kicker here is that when we pay insurance companies, they do something with the money. And they invest it largely in bonds. Chubb has $117 billion in their bond portfolio. Its average term is about 5 years. So you can see that reinvestment opportunity is ripe for them. As low-paying coupon bonds come due, they're able to reinvest it at higher levels.
Okay. Chubb is number 2, and number 3 on this day, Dana, ticker symbol DAN in New York.
An auto parts supplier, we think will do very well through electrification. The margins are much higher through electrification than through traditional ICE technology. Another industrial. We've talked a lot in the show, Paul, about the consumer and the industrial and how I think it's a bifurcated market. If anybody wants to read more about it, we've just put out our commentary for September.
Okay.
It's on our website, goodread.com. Just go onto that, go to Insights, see the sign-up page, and you can see not only that, which we call the gauge, but you can see anything else we've written over the last 10 years.
Okay, and you mentioned the phrase ICE, that's internal combustion engine,
yes.
Traditional automobiles, correct?
Yes, it is.
Okay, those are Gordon Reid's top picks. They were in order: Booking Holdings, Chubb, ticker symbol CB, and Dana, ticker symbol DAN in New York. Gordon, thank you a great deal, as always, on behalf of our viewers.
Thank you, Paul.
It's good to have Gordon Reid with us always. Welcome back. Time now for top picks with our guest Chris Blubus. Up first, is Alimentation Couche-Tard, the convenience store giant based in Quebec and active in many parts of the world, including Canada, the U.S., and Europe.
Yeah, so I mean, I think this is a very unique business. You know, they're very, very good at allocating capital, and they do something that's really, really tough to do. You know, it's really hard, and it always has been hard to make these C-stores as profitable as they've made. And I think that's why, they do so well when they do acquisitions. And I think, kind of coming into where we're at now, you've got a company with a very reasonable valuation, a very strong balance sheet to complete acquisitions. And, the market is so fragmented, and you look at oil companies looking to kind of get out of the retail side of it, and them being just such a first-class operator, the future is very bright. It kind of ticks all the boxes, and I think will do quite well over the long term.
Okay. Alimentation Couche-Tard, number one. Number two, Enbridge, the pipeline giant. Chris has referenced pipelines a couple times in the show today. This looks like his top pick in the sector, ENB on the TSX.
Yeah, I always like to have an income pick for people, because I know income is topical for a certain segment of the viewers, and I think this is one I've alluded to that I like. And I think what maybe gets a little bit lost with Enbridge is, it's so defensive. Even in recessions, cash flows go up. Maybe the share price doesn't because of sentiment, but you look at they recently did. They have an acquisition that's likely going to close next year, where they bought 3 U.S. gas utilities. So you look at what they're doing to kind of further diversify the business. So, half of cash flow will kind of come from the oil pipelines, half the cash flow will come from natural gas and renewables. So I think this is a business similar to Couche-Tard. These are two businesses that in a tough environment just allocated capital and did all cash deals to capture value for their shareholders. And not every company can do that. So, when you're looking at investing in this type of an awkward market, look to invest in companies that can take advantage of these opportunities for you. That's
Chris's second pick, Enbridge. Yeah. Walt Disney is number three, ticker symbol DIS. A lot of people disappointed in this one. You think this is maybe the right time to get in. It's down substantially over the past year.
Yeah, it's down substantially over the past year, and it's down substantially over its 5-year high, right? Like, this is a business that's got hit really hard from the kind of transition away from kind of traditional media to kind of new age media. And I think, what is unique about Disney is they have so many different assets. They have, regular, old, linear TV, they have direct consumer, they have parks. They have such a wide variety of assets. And the thing is, they don't all perform well at the same time. And I think parks are doing phenomenally well right now as people look to experiences after COVID. And I think there's just such a massive amount of pressure to kind of improve profitability and unlock some of the hidden value. Like, I think conservatively, this is trading at a 30 to 40% discount to its sum of the parts. There's been activists involved. There's been a higher level of activist involvement recently. They are listening. They are taking concrete steps. And if you look at kind of the projections for earnings going out the next 3 and 5 years, this should be a very, very attractive company, and it's something that has a lot of upside. So it's one that I do really like.
Chris, on behalf of our viewers, thanks a lot for being here today.
Thanks for having me.
That is Chris Blubus. He was our featured guest here on Market Call. Welcome back. It's time now for top picks from Paul Harris. Just before we do that, I want to give a more complete answer to our final caller who asked about Brookfield Infrastructure Partners. So we noted that there's 2 publicly traded vehicles that reflect Brookfield Infrastructure Partners. Here's the difference, and we'll show you the graphs. There's BIPC on the TSX. Its dividend qualifies for the Canadian dividend tax credit, whereas the other vehicle, BIP.UN, that distribution from that income fund consists largely of foreign dividend and interest income, Canadian interest and return of capital. So the key difference appears to be that BIPC qualifies for the Canadian dividend tax credit. Okay, Paul Harris and top picks. Your top pick number 1 today, Toronto Dominion Bank, TD on the TSX.
Right. So, TD is a company that we've liked for a long time. I don't think it's expensive here. Like I mentioned about all the banks in Canada, it's trading at 1.4 times book. It's got a 3.4% dividend yield. Sorry, it's got a much higher dividend yield than that. But 4.5, I think, dividend yield. And it's got lots of capital. I mean, their Horizon deal didn't go through, so they have lots of capital. I think they can, certainly do a deal in the United States. Canadian banks are well-diversified businesses, right? So people have to remember that they're not kind of U.S. banks in Silicon Valley or First Republic. They're diversified through many businesses, lots of fee income. They are well regulated, and I think that it's been a tough year for banks this year, because I think there was a lot of expectation that net interest income was going to be higher because of interest rates, but there were a lot of costs involved for banks, and I think they need to bring down their cost structure. But I think TD is in a very good situation with lots of capital. They can buy back their shares, they can increase their dividend with no problems, and they can make an acquisition if they decide to in the States still. So I think that I think if you're buying the banks here at these levels, I don't think you'll be in good shape in a year from now, or a year or 2 years from now. You'll do very well, and you get a very nice dividend while you wait.
TD now yielding 4.77%. Stryker is number 2, so we go to the U.S. medical devices field. Paul?
Right, so Stryker is a medical device company. They do hips, knees, they do other spines. They bought a company called Wright Medical that does hands and ankles. So one of the things happened with these companies is that they kind of did poorly through COVID because a lot of their surgeries are elective. Now there's a big backlog and they continue to do well. So one of the reasons why the stock has fallen in the last little while, funnily enough, is because a company called Novo Nordisk, which we own, which has come out with these obesity drugs, and people think that they won't have to get surgery because of this, but actually, if you are obese, you can't actually get the surgery even if you need it. So you need to bring down your weight before they would do that. So I don't think that takes away anything from this company. I mean, 73% of their business is the United States. The remainder is in Europe or international or in emerging markets. So I think that there's still growth in emerging markets for this company. And there's a bit of an annuity with this company in some sense, because although an orthopedic surgeon doesn't switch between knee products all the one day they're doing this, one day they're doing that. They tend to use the same products all the time. And then there's a demographic play. The population is getting older. This really kind of changes their quality of life, keeps them off drugs, et cetera. So I think that there's a lot to be said about medical devices, and I think this company can, one, also make some acquisitions over the next little while in the medical device space, which I think will be very important for them.
Okay, and we stick with the healthcare sector for our top pick number 3, Johnson & Johnson, J&J in New York, a company that's been in the news recently.
Right. So Johnson & Johnson has had a kind of a terrible year. So I think that one of the reasons I like the stock is that it's not trading at a high multiple. It's got a nice dividend yield. It increases their dividend. So they sold off their consumer division. I can't remember the name of the Cano. They sold it off, which had Tylenol, et cetera, in it. And now they're basically a pharma company and a medical device company. In their last quarter, they beat earnings. This is the first quarter where their consumer business is not involved in their in their numbers. They beat earnings. The other thing is they saw the medical devices grow by 10%. They saw pharma, which they have a different name for today, but they saw pharma grow by 4.5%. So, I think this is an area where it'll continue to grow. They have lots of cash now to go and buy either pharma stuff or medical device stuff. So I think that's what's going to happen. And they certainly have a track record, I think, of 54 years of increasing their dividend, which I think will also happen. So one of the reasons I did like the stock because of these 3 divisions, but I do think they're in the right space. The one other issue, obviously they have some issues with talcum powder, which they've reserved for, but they will appeal that these constantly in the U.S. legal system. They can constantly appeal the stuff, which they will do, and they're very good at doing that. The other thing is that they have a drug for psoriasis, and I think that's coming off patent, so people are worried about that as well. But I think they have enough things in their pipeline that are going to make up for this, and I think they will actually make some reasonable acquisitions that will help them. So I like the stock. You're not paying a lot for it today. You're paying a below market multiple on it. You got a nice dividend yield. I think it's a well-run company. I think what they did, they used to own 90% of the consumer business. They don't own any of it anymore. They spun it all out, and so now they're just a pure pharma and a pure medical device company. And I think that at these levels, I think you're getting a good deal on the company for the long term.
Okay, that's Paul Harris. His top picks again on this program on this day: TD Bank, Stryker, and Johnson & Johnson. Welcome back. Time now for Lawrence Steinberg's top picks. Number 1, CIBC. He's talked in general about the Canadian banks. Now he'll talk specifically about this one.
Canada's fifth largest bank, Paul. They've actually had similar growth and success compared to Canada's best banks, but they've been in the penalty box seemingly forever based on some past missteps going back to 2001 and since then. And that leaves this bank trading around 9 or 10 times earnings with a 7% dividend yield, a great presence in wealth management and retail banking, and probably less capital markets risk than some of the other larger banks. And so, again, 7% dividend yield. The top 5 banks have never cut their dividends in Canadian history. It's hard not to be attracted to this company, and we're looking for a double-digit return over the next many years.
Okay, what kind of job do you think Victor Dodig has done of running the bank? He's been in place for several years now.
I think he's done a really good job, and he's kept the focus where it should be, which is on their strengths and not try to get them into other areas. And like all the banks, these banks are efficiency machines, and so we're seeing the banks with net layoffs these days, and driven by technology, really. The technology is driving so much of the profitability of Canadian banks.
Okay, let's go to number 2. We're going to the New York Stock Exchange for this one, Kenvue, ticker symbol KVUE.
So Kenvue is the recent spin-off from Johnson & Johnson. This is their consumer health business. So investors may not be familiar with the name, but they certainly know Johnson's baby shampoo, Neutrogena, Tylenol, etc. It is a first-rate consumer products company with a slew of top brands, and it trading at a steep discount to the rest of the sector, around 15 times earnings. They've announced their basic dividend policy, so investors will be picking up about a 4% dividend. The one little fly in the ointment, hopefully, is there is some acetaminophen, which is Tylenol, some litigation about impact on pregnant mothers and impacting things like autism in children. We have no idea. It's been this, of course, drug's been around forever. They are fighting aggressively, but in the U.S., there's always the possibility, you can get hit with something on those class action lawsuits. Nonetheless, we feel that the share price more than is taking all of that into account. And this is, the brands they have are second to none.
Yeah, indeed, my Bloomberg screen shows the top 3 news stories as announcements from 3 different law firms announcing what look like class action lawsuits on that or related subjects. Kenvue, ticker symbol KVUE. And finally, we are going to Europe now. Kering SA. You're going to have to tell me what this company does, Lauren.
Sure. So Kering is in the luxury goods business. So their top brand is Gucci, Yves Saint Laurent, Balenciaga, and they recently made a significant acquisition. And I will confess I've never heard of this company before, but it is a luxury fragrance company with margins that are insane. And of course, with so much free cash flow in this business, they made that acquisition of almost $4 billion through existing free cash flow. They're trading at 15 times earnings. The margin in the whole business are huge. People who buy those brands seemingly, don't care almost what they're paying for them. And Kering's delivered double-digit revenue growth over the last many years, slightly slowed down recently. They have a new designer in at Gucci. What does that mean? I have no idea, but I'll assume that they know what they're doing. But paying 15 times earnings for this company with a 3.5% dividend yield, it's trading at such a steep discount to companies like LVMH that I think it's hard to go wrong.
Okay, those are Lawrence Steinberg's top picks on this day. We'll visit with him before too long, but about a year from now as well. He'll be here and we'll take a look back at those picks. CIBC, Kenvue, and Kering SA. Lauren, I want to thank you on behalf of our viewers for all your help today.
Well, thank you so much for having me here. Really enjoy myself.